The difference between an index fund and an actively managed fund. Definition of index fund. An index fund is a type of mutual fund or exchange-traded fund, ETF, that aims to replicate the performance of a specific market index, such as the S&P 500 or the NASDAQ 100. Index funds passively track the holdings and weightings of their benchmark index to achieve similar returns for investors. Investment strategy. Index funds follow a passive investment strategy, meaning they aim to match the performance of the index they track rather than actively selecting individual securities. This strategy minimizes trading activity and management fees, making index funds cost-effective investment options. Diversification and risk management. Index funds offer broad diversification across multiple companies and sectors within the index. By holding a diversified portfolio of securities, they reduce specific risk associated with individual stocks and sectors, providing investors with exposure to the overall market. Performance and returns. The performance of an index fund closely mirrors the performance of its benchmark index, minus any fees or tracking errors. Index funds aim to deliver market returns over the long term, providing investors with a reliable and predictable investment outcome. Cost and fees. Index funds generally have lower management fees and operating expenses compared to actively managed funds. This is because they require minimal oversight and trading activity, resulting in lower costs passed on to investors. Definition of actively managed fund. An actively managed fund is a mutual fund or ETF where fund managers actively select and trade individual securities with the goal of outperforming a benchmark index or achieving specific investment objectives. Unlike index funds, actively managed funds do not seek to replicate an index's performance. Investment strategy. Actively managed funds employ a hands-on approach to investment management, where fund managers make decisions based on market analysis, economic trends, and individual stock research. They aim to capitalize on market inefficiencies and identify opportunities for generating alpha, excess returns. Diversification and risk management. Actively managed funds may have more concentrated holdings compared to index funds, as fund managers selectively invest in securities they believe will outperform the market. This approach can potentially increase returns but also expose investors to higher levels of risk and volatility. Performance and returns. The performance of actively managed funds varies widely depending on the skill and expertise of fund managers. While some actively managed funds may outperform their benchmark indexes, others may underperform due to higher fees, trading costs, and the challenges of consistently beating the market. Cost and fees. Actively managed funds generally have higher management fees and expenses compared to index funds, reflecting the costs associated with active investment management, research, and trading. These fees can reduce overall returns for investors over time. Understanding the differences between index funds and actively managed funds helps investors choose investment strategies aligned with their financial goals, risk tolerance, and preferences for cost effectiveness or potential for outperformance in the financial markets.